welcome to MF Primer. The term that we are discussing today is CAGR. If you're a mutual fund investor or you wish to become one, this is a term that you will see everywhere. In mutual fund fact sheets, in newspaper articles, advertisements on billboards, anything that refers to returns from mutual fund schemes will have the term CAGR. So yes, that's your clue. It is related to returns you earn or rather have earned from your mutual fund scheme. The expanded form of CAGR is compounded annualized growth rate. We also refer to it as annualized returns. So what is it? Well, it is the return that you've already earned from your mutual fund scheme by holding it for a period of time. So let's say you bought it 5 years ago and you've held it for so long. So you've earned a return from year 1 to year 5. We take that entire return and break it up into smaller parts of annual returns. And your CAGR just represents that. Remember, mutual fund return is never earned in a straight line. It is always up and down, up and down. There is volatility involved. Market-linked investments like mutual funds, no matter whether it's in debt mutual funds or equity mutual funds, will have volatility. Returns will go up and down on an annual basis. If you start looking at the return every year, you will get unnerved. So what we sort of do is invest and we leave it for 3 years, 4 years, 5 years, whatever your time horizon is. And at the end of that, when we look at returns, we look at the CAGR return, which is basically your total return broken up into the average annual performance. Why do we do that? Why do we complicate it so much? You see, your fixed deposits just give you an annual sort of interest rate. So, every year you'll get 6%. Or your real estate deals, you talk about the absolute return. I bought it for 1 crore, sold it for 2 crores. We really don't talk about this annual breakup that CAGR does. So why for mutual funds? Well, for 2 reasons. Firstly, it's easier to compare. You see, we also recommend that mutual funds are a long-term investment, especially equity mutual funds. So you're holding them for many years. When you hold them for many years, your different investments start at different points in time. If you're investing across asset classes or across different mutual fund schemes, you have not bought everything on day 1 and holding till, year 5 and then selling everything. So when you buy and sell at different points in time, you need something to compare the return. So what's in your CAGR? CAGR helps you compare returns because it breaks down, no matter what your holding period, it will break down return into annual buckets. And so you know that, okay, my mutual fund scheme A gave me this much annualized return, mutual fund scheme B gives me this much annualized return. The second thing that it does is that, it makes it easy to comprehend what your return is. For example, if you have left your investment in for say 15 years or 20 years, often happens with things like real estate, where you bought, like I said, on a day 10 years ago, and 10 years later you're saying, look, I doubled my return because my property is worth double the price and I'm happy. But in 10 years, if the doubling has happened, then you've earned just 7.1%. If the doubling has happened in, say, 5 years, then you've earned close to 15% a year. If the doubling has happened in, say, 3 years, then you've earned 26% a year. So it matters. Your annualized return matters. Just saying that you've doubled is not necessarily the most clear picture, because it matters how many years you've taken to double. So you have to... it's easier to digest. You cannot digest these big numbers after 15, 20 years when your investments are giving you 400% return also, or 200% return. We break it down into annual buckets so that it's easier to compare and it's easier to comprehend as well. What it is not is the return. CAGR is not the return you're getting for your investment in the next year. Definitely not. It is not a defined return that you will get year on year. It is just what you have already earned broken up into annual buckets. And make no mistake, from mutual fund schemes, a CAGR return is not a guaranteed return. No matter what you do, please do not think that this is the return you're going to get next year as well, or that it is a guaranteed return. So there you have it. CAGR is definitely an important part of your mutual fund investments. It is annualized return for what you have already earned, not what you will be earning in future. Thank you for watching. For more such conversations around everything mutual funds, do keep watching MF Primer.